I think we're good to go. Let's see. Clearly, this is not something that I do every day. This is my first webinar. It's my first pop-up webinar using Zoom. We normally do this in the form of meetings. Um, Thank you for being here. It's my honor to share the next hour with you and hopefully convey some knowledge and a bit of what I've learned over the last 30 years in the industry of commercial real estate and debt management. Quick background on me. I've been in the industry for just over 30 years. I started my career as a very young vice president at Bank of America in 1990. I guess that makes it 33 years, doesn't it? Where eventually I managed multiple divisions, including the CEO of the special servicing operation. But subsequent to that, I've also managed several multi-billion-dollar investment platforms. Um, Commercial real estate is something I'm passionate about, and I'm certainly passionate about distressed commercial real estate because it reeks of opportunity and challenge, both of which I just find very compelling. So again, my name is Stephen. I'm the Chief Restructure Officer at Performance Advisory Group, where we invest in distress, we teach about distress, and we negotiate on behalf of our clients as an advisor to restructure debt, retain assets, do discounted payoffs, note acquisitions, whatever the case calls for. That's what we do. I think I've done something north of $11 billion of total transactions over my career, but that's enough about me. I'm not really that interesting. Let's jump into. Uh-oh. How do I share my screen? Oh, here we go. Let's jump into the concept here. Bear with me just a moment. So the subject of the meeting, guys, is commercial real estate, distressed commercial real estate, pivot and profit from what I see as the greatest dislocation in the last 30 years, since I at least have been in the industry. It's extraordinary, and there's a lot of reasons why we're there. So what we're going to talk about is how we got here, what to expect in the future, and then how to take advantage of these opportunities. Because if we don't pivot as an investor, owner, borrower, broker, mortgage broker, any kind of service provider, if we don't pivot, there's going to be some suffering that goes along with that. So to jump right into it, let's just talk about what got us here. And firstly, it's what I call grossly reckless Federal Reserve policy. Federal Reserve dumped more than $17 trillion into our economy almost overnight. Now, numbers are a bit challenging to fully comprehend. Millions of dollars used to be something significant 10, 20, 30 years ago. Then it became billions, and now it's apparently trillions. M1, which is the primary money supply, blew up by more than 500% over less than an 18-month period. It's something that's never happened in the history of the world. Here's a chart. So M1 is the primary money supply. It's the money in your bank account, checking accounts, the money in your pocket, money in your safe deposit bank, whatever. But it's grown. This starts back in roughly 1970. It's grown consistently over an extended period of time. This gray bar here represents the Great Financial Recession. And immediately post or during it, Ben Bernanke, who was the then Fed chairman, said, let's crank up the printing presses. And if some of you remember, he was given the moniker of Helicopter Ben Bernanke because his idea was to stimulate the economy by throwing a bunch of cash at consumers. Consumers drive, as you know, 70% of gross domestic product. So note this, guys. Over a roughly 10-year period, we went from $2 trillion to $4 trillion in rough numbers in terms of M1, the money in circulation. And that was a huge experiment. That was something that, as you can tell from this chart, has never been done before. Along comes the great pandemic. And In pretty much overnight, we went from 4 trillion to 16 trillion, 300% increase in M1. And then over the next 6 months after that, 12 months, we increased it by a gross amount of $17 trillion. This is an experiment that we have never seen in the history of the US, in the history of the world, barring maybe Weimar Republic post World War I in Germany, or maybe Zimbabwe in the early 2000s, late 1900s. It's never been seen before. And this gross injection of monetary policy through QE, stimulus checks, PPP, created a lot of wealth here in the US. And it was that wealth that has driven, I should say, massive asset bubbles in virtually every asset class. And then what we did, or I should say they did, as the Federal Reserve, is they radically reduced interest rates. And they do that through a variety of mechanisms. In this case, they bought a lot of mortgage-backed securities. And so they artificially lowered interest rates pretty much across the board. And in doing so, they grossly exacerbated the bubble that already existed or was blowing up. Now, look, I'm not talking about just single-family homes or commercial real estate. If you look across the board between mid-2020 and mid-2022, almost every asset class, whether it's the stock market, used cars, single family homes, certain elements, commercial real estate, they all increased by about 40%. Turns out that's the average increase in M2, but that's a separate conversation. That liquidity plus really, really cheap debt artificially stimulated demand. What I mean by that is that everybody got rich, everybody went on a spending spree, as you know, and that pushed values or prices across the board. So let's use single-family homes as an example. Single-family homes stopped trading based upon prices, and they started trading based upon monthly payments. So what we did is we put a lot of money in the consumer's pocket. Now we increased the buyer pool, and then we reduced the cost of capital, meaning that we allowed a buyer to buy a lot more home because interest rates associated with a loan were much, much lower. And so we created what I call the bubble of everything. If you look at my YouTube channel, I've got videos going back 3 years now on this, saying Federal Reserve has just created a bubblicious economy, for lack of a better term, and that economy will unwind at some point, and it will unwind in a very negative manner. And that's kind of where we're going right now. Getting back to the subject, I'm focused pretty much on commercial real estate. That's what I know and love, although single family is near and dear to all of our hearts, isn't it? So what happened? So let's take a look. So M1, primary money supply in our economy jumped north of 500%. As you can see here, it's unwinding through QT, quantitative tightening. But here's the big issue. If you look for what's causing the distress across the board in our economy, it's interest rate management, interest rate policy. Look, the Federal Reserve, and you're going to find that I am not a fan of the Federal Reserve. I think the best thing that could happen is that if we replace Jerome Powell as the chair and most of the members of the FOMC, because they've driven us to the point of, for me, exhaustion. Bankruptcies are at or close to an all-time high, and they're accelerating. That's a really good indication that they have failed in their policy management. So fundamentally, the Federal Reserve is responsible for three things, guys. Price management or price stability. Prices should move gradually over time. As I just pointed out, that didn't happen over a 3-year period. Prices increased by an average of 40% across most asset classes. If you look for things like Bitcoin, it was up 600% in less than 12 months. FOMO. Anyways, it's this reversal of policy that's caused all the distress. We went from all-time interest rate lows. By the way, this is a 30-year fixed rate mortgage average here in the US. As you could see, we're not real. Our interest rates are really not that high on a relative basis. Going back to 2000, we're about par with that. Going back to 2008, we're about par with that too, right? That was the peak of the subprime mortgage debacle that looks a lot like in many ways our situation today. But it's this reversal of interest rate policy that is causing so much distress, whether it's bank failure or commercial real estate value destruction. It's a problem. I mentioned it here. It's a little bit like being fed drugs by your dealer and then all of a sudden being cut off. You go into great withdrawals, and that's kind of what's happening today. Although certain asset classes take a while to experience that sort of change. Um, what's making the matter worse is that we've got an expanding credit crunch as a result of Federal Reserve policy relative to interest rates. They have created a situation within regional banks in particular where nobody wants to leave their money on deposit because that return on deposit is about 1%. They could take that money and earn 5% somewhere else in the market, whether it's through treasury bonds or bills or through money market funds. So we've seen a massive outflow of deposits. And to exacerbate that, we know that there's a concern about the credit quality of the assets on a regional bank's balance sheet, which is mostly commercial real estate loans and mortgage-backed securities. So massive injection of liquidity followed by a massive reduction of interest rates is now, and that reversal, interest rates are popping, causing extraordinary distress across the board, conjunction with a massive credit crunch. And we have a lot of problems. 3 of the 4 of the largest bank failures in the history of the United States have occurred in the last 6 months. That's telling. My question for you, is that just sort of the tip of the iceberg? I kind of think it is. We make the matter worse by talking about the work from home phenomenon and the fact that I'm going the wrong direction here. Sorry, guys. Work from home phenomenon. Oh, no. Like I said, I'm not super good with this. As you can tell. I'll use these buttons instead. So a lot of things are exacerbating the situation. Work from home, buy from home, failed government policy regarding crime and homeless. I don't know if you've seen any videos or personally experienced downtown locations, particularly out here on the West Coast, but between Seattle and Portland, San Francisco, Los Angeles, San Diego, downtown locations are essentially war zones, and they're really, it's tragic what's going on there. Yeah. And I don't see an immediate reversal of that. I don't know about you guys. So M1, huge problem. You can't inject that much liquidity in the marketplace without creating bubbles. You reverse those bubbles by quantitative tightening, which is shown here by simply dramatically increasing interest rates. That puts a massive damper on spending. And as you probably know, 70% of our gross domestic product or gross output here in the United States is a result of you and I spending money on goods and services. So where are we at today? Hopefully this is where it gets a little bit more interesting, although that foundational information I think is important. Cat 5 hurricane, commercial real estate's in the crosshairs of a Cat 5 hurricane and a maturing tsunami of debt. Bank deposit outflows and credit losses are likely to exacerbate the credit crunch, meaning that there's less money flowing into our commercial real estate market, and that's a problem. Commercial real estate flows and fundamentally exists based upon leverage, and when leverage leaves the building, that's going to be a problem. I don't know if you've tried to refinance something like retail or office recently, but it's damn near close to impossible no matter how good the deal is. There's also a massive, massive spread between buyer and seller. And that spread's not likely to resolve anytime soon. Sellers expect prices up here where, given what interest rates have done, prices should be down here. And that's, again, not likely to reverse anytime soon. SLOO's report, which is the Senior Loan Officer Opinion Survey, says that a vast majority of banks continue to tighten their credits. continue to tighten their lending standards and their willingness to inject new capital into the marketplace. Excess liquidity is now reversing, meaning that we talked about average household wealth increasing to levels actually never seen before in the midst of the pandemic as a result of that injection of liquidity. That money's almost all gone. We expect that money to be largely gone by end of third quarter, beginning of fourth quarter, which could very well be, I don't know, we don't know, the trigger that causes the next recession, great recession. I don't know. Here's what I want to say to you, though. For those in the commercial real estate industry, either as buyer, borrower, investor, owner, service provider, or potential investor, every maturing loan and every default will be a transaction of some sort. And we'll talk about that here in a moment. This is the maturing loan report, right? It's an indication of what's maturing over the course of the next, call it 10 years. You notice up here in this front-loaded section that over the next 2 years less, we've got close to $2 trillion worth of maturing mortgages, the vast majority of which are not refinanceable given the lack of liquidity and the gross expansion of cap rates. This is going to cause a lot of distress. In addition to the dramatic and rapid increase in interest rates or the cost of capital for the borrower, there's going to be a lot of loan defaults, and that's already starting to happen. We're seeing, particularly multifamily, we're seeing a ton of defaults in that space. This is an indication of bank lending standards. If you notice here, that talks about tightening, percentage of those tightening. We're not quite yet there in terms of where we were in 2008 and then going back to 2000, two massive recessions, but we're well on our way. This slight turn doesn't mean a thing. So where do we go from here, and how do you pivot and profit? It's fundamental to understand that lenders and servicers are increasingly in a loss position, and it's a game changer. Instead of the typical transaction being just a willing buyer and a willing seller, now we need a willing lender or servicer who's willing to, in most cases, take a loss. So they effectively control the purse strings. And it's really, really, I mean, if there's one thing I want to share with you as it relates to lenders, super important to know, is that every lender or servicer has one primary goal, and that is to minimize losses, maximize recoveries, and do so on a net present value basis. So what transactions are occurring today? That really begs the question, because how do you get involved? What transactions are starting to see actual volume occur instead of, as you know, typical transactions are off 70-80%. First thing is note sales. With the failure of Silicon Valley Bank and Signature Bank and First Republic, the FDIC has now been tasked with dissolving their balance sheets. And so the easiest way to do that, particularly with an insolvent enterprise, is to sell the notes. Depending upon a variety of things, including the credit strength balance sheet of a borrower sponsor, those notes will sell for sure far below par, and in most cases at a significant discount to the underlying value of the real estate. So I'm telling you, in note sales, we're seeing note sales selling as much as a 50, 60, 70% discount to their par value. In other words, the face amount of the note, 70% discount, as much as that. I would say this: if you're in the business of transactions as a broker, mortgage broker, potential buyer, learn the business. Note sales will be a significant portion of future transactions, particularly over the course of the next 12 months. We talked earlier about our bank failures, just the tip of the iceberg, the first 3 or 4 that we've seen this year. The answer, in my opinion, is certainly yes. And as more of these failures occur, or more of these enterprises be acquired by larger groups like JP Morgan and Jamie Dimon's teams, note sales will certainly accelerate. They're an easy way for banks to not only get rid of non-performing loans from their balance sheet, but also recapitalize their balance sheet, put cash to replace the deposits that are outflowing on their balance sheets. Discounted payoffs are huge. We have led the transactions of note sales and acquisitions a lot over the last 6 months, but we're starting to see a dramatic increase in discounted payoff. Now, what is a discounted payoff? It's when you retire a bank loan or special servicer loan at an amount that's less than the principal or par balance of the note. So let me give you an example of this. Last month, we negotiated a very large restructure, which included pref equity, LP and GP equity on a property in Northern California that was acquired in 2019. Values, it was office building, by the way. I can't disclose names, locations, etc. We always do an NDA, but we sold the building through a discounted payoff to a related third party for 50% of what it was bought for in 2019. 2019, it was bought for $29 million. In 2023, it was sold for $18.7 million, a massive discount. It was sold to a related third party, not related from a financial perspective, but we brought that third party in, paid the bank off at a massive discount, and now the basis has been reset for the new ownership at a much lower level. So discounted payoffs, easy way for banks to recapitalize their balance sheet, take non-performing loans off their balance sheet, and for you to step in and acquire assets as a broker, any kind of service provider, potential owner, investor, at a massively reduced basis. And what's really important to know here is that being on a reduced basis gives you a huge competitive advantage. Hey, Roger, in this other section, can I give you more examples? I'll give it a go. But I tell you what, if you could all save your questions to the end, and we'll jump through them really, hopefully effectively and quickly. So it's also important to know that in addition to note sales and discounted payoffs, and by the way, banks, again, control the purse strings, and they will for the next 2 to 4 years. Lenders and servicers will almost always start the foreclosure process. If your loan is maturing, they'll start the foreclosure process. If your loan is in default, they'll start the process of foreclosure. At least they should. And the reason why is they want to protect their downside. As I mentioned earlier, their objective always is to maximize recoveries and minimize losses on a net present value basis. The worst case scenario is they have to foreclose and liquidate the real estate. To foreclose, you have to start the process, which is a notice of default, notice of trustee sale, at least here in California. Eventually, you own the real estate and you liquidate it. There's other alternatives, including the appointment of receiver. But yeah, foreclosures always, almost always, I should say, end up with the lowest recovery rate and the greatest losses. So the last thing a lender wants to do is foreclose, but they're going to be forced to in many situations. For office, as an example, there are very few buyers out there today. The number of buyers will certainly increase going forward, but today it's relatively low because we have zero price discovery. We have very few lenders in the space, and the vast majority of us think that there's a lot of downside to experience. Look, I'll talk about this later perhaps, but we're not buyers today. We are preparing to buy, and on a one-off basis, we'll buy. Doesn't matter the asset class, as long as we're buying well, meaning typically it's below replacement value and at a basis far below our competitive set. So look, lenders will be forced to foreclose, and that is a huge opportunity for those of you in the service industry. If you're in the title company business, there's a TSG, there's transfers, and there's eventual sale of the real estate, which is another policy option and opportunity for you. If you're a broker, there's the opportunity to list and sell the real estate either through the lender who eventually owns it or through a receivership. I'm not going to go into great detail there, but I will tell you that these things are happening in real time today, and our expectation is that they accelerate dramatically. Let's go. Where are we at? So for owners, investors, I say protect what you have and avoid foreclosure. We've seen the likes of PIMCO, Brookfield, Starwood, Columbia Trust, some of the best and the brightest in the industry, effectively turn over the keys to the lenders. And the lenders don't want these keys. The lenders don't want to own the real estate. It's the last thing they want to take on. It's a liability. It adversely influences their income statement, and the cost to carry is unknown. And more importantly, we generally believe in the industry that values will continue to fall. When the distress cycle starts to occur, values will fall for an extended period of time. If you look at history, from peak to trough, it's usually about 5 years, whether it's single family, the equities market, or commercial real estate. Foreclosure is the last thing a lender wants to do, but you need to understand that business because it will occur. Some of the less sophisticated lenders, and in some cases that means regional banks, don't look at the options like a note sale or a discounted payoff. They say, oh, guy defaulted, we're going to have to foreclose and liquidate it. One great example of this type of situation, there's a building called the AT&T Plaza. It's in St. Louis, Missouri. In 2016, it was valued at $210 million. It was managed through a special servicer who went through the foreclosure process. It took some years and years. Eventually, they foreclosed and sold the property. Previous value, $210 million in 2016, sold in 2022 for $4 million. This is a 1.25 million square foot building, sold for $4 million. I think about what you could do with that. Opportunities and options are extraordinary, but it's a really good example about why they don't want to foreclose, but it's also a huge example about where the opportunity looks to be coming from in the future. Lenders will foreclose, and when they foreclose, you can either buy at the auction, foreclosure auction, or buy through a receivership, or buy through the broker on an OM general offering post foreclosure. By the way, this pop-up webinar is the first in the series. Once a week, we're going to be doing these. Next week, I'll wait for Q&A, but next week it's likely to be focused on investing in distress and creating generational wealth. In other words, I'm talking about opportunities here, but I'm going to do a deep dive next week. The other option for next week is to restructure commercial real estate debt and avoid foreclosure, which is the subject right here. Extending loans. So a lot of the defaults today are a function of maturing loans. We know that multiple regulatory agencies like the OCC, the Federal Reserve, are saying work with your borrowers, minimize distress, minimize downward pressure on valuations and upward pressures on cap rates by being reasonable. If the borrower has a decent plan, work with them. Unfortunately, more often than not, the borrowers don't come up with a decent plan. I'll give you a link to my book later on in this presentation, but it's all about managing through a defaulted loan and executing restructure, loan modification, etc. I walk you through the process, but it's really three things. It's create a plan, which is a business plan, generate a pro forma, which shows future cash flows, and create a comprehensive proposal. If you don't come to your lender with a plan, pro forma, and proposal, you're likely to get stuck on the bottom of their stack. And by the way, that stack of defaulted mortgages is growing on a daily basis. Another huge opportunity is to pay off your loan at a discount. The discounted payoff option, we've done, I don't even know how many at this point, but discounted payoffs, again, get the loan off the balance sheet of the lender and transfers the asset to a new third party who can inject new capital, minimizing distress, but has an immediate opportunity to create value there. We had a assisted living facility in Northern California that looked a lot like this. Underlying basis with $30 million, we sold it for, we participated or structured the sale for just over $10 million. The new investor threw $1 million at the asset, rebuilt occupancy, and now the asset's worth something close to $22 million. So those kind of deals are there today. works well for the lender, and it works really well for the new investor. By the way, pick a good team. As you're going through the process of restructuring debt as an owner and investor, pick a good team. By the way, attorneys are critical for the process, but they should not be leading the strategy. That typically does not end well, mostly because if your legal counsel is leading the conversation, bank has to bring in counsel to lead the conversation, and it tends to be slow and cumbersome and is not optimized. Pay your loan off at a discount, which is a discounted payoff, reduce your basis, and create a competitive advantage. When I say competitive advantage, what I'm talking about, guys, is if your competitive set owns their real estate on an average of $300 a square foot, and you're now into yours through whatever mechanism we've talked about, $100 a square foot, you can grossly undercharge from a rent perspective, but massively from a return perspective, outperform your competitive set. So huge. Another opportunity for those existing owners and operators, borrowers and managers, is to settle your guarantee liability. Settling guarantee liability is a challenge for a lot of people these days, but the reality is banks don't want to hold on to this guarantee liability any longer than they need to, because it shows up on their balance sheet as well. We recently, a few months ago, we settled a $9 million recourse liability by writing a check for $250,000. How? We understood at what level the bank was carrying that asset. We understood that they wanted to get rid of that asset by the end of the year because it doesn't look good on their income statement or balance sheet. The borrower had previously offered $2 million. We wrote a check for $250,000, and the bank was happy to say, thank you, goodbye. I think that's enough on the subject. We're going to go into great detail in a week or two. Download my book, especially if you're in the mortgage banking or brokerage industry. My expectation is we're going to see a huge pivot. There's not a lot of new debt being placed today, but a lot of existing debt needs to be managed. The book will give you a great insight to it. We're teaching a course to mortgage bankers and brokers and have a referral program. So my strong suggestion, and you're going to hear this a lot over the course of the next 5 minutes, 10, book a call with me. Let's talk. There's a lot of ways to pivot and profit. So a lot of you here for this particular reason. Biggest opportunity, generational wealth. Single best investment over the last 100 years. If you've seen some of my other videos, you know this. Commercial real estate is tax protected and has outperformed the S&P as an example over the last 100 years by 700%. We're seeing discounts on commercial real estate, which again is the best asset class in my opinion, although certainly unbiased. And those discounts are as much as 95% off previous values. And by the way, that discount is going to grow. So my strong suggestion is to prepare yourself. Start small and grow. I mentioned earlier, we're not buying today. I started my career small. And on the investment side, in 1992, I bought a triplex, 3 rental units in a local city called Tustin here in Southern California. I paid $200,000 for those units in aggregate. It was a property that had been foreclosed upon by the lender. And so the lender only required 10% down. It's called a loan to facilitate. A loan to facilitate allows the lender to get the property off their books. And so they don't have to worry about carrying it. They don't have to worry about insurance. They don't have to worry about damage, management, etc. They get it off their books. They give you a better than market loan. It's called, again, a loan to facilitate. I put 10% down in less than 3 years. I 10x'd that 10%. That $20,000 went to $200,000 because I took the time on weekends and weeknights to remodel. So I did drywall, I did some plumbing repair, new carpet. Interesting, and you'll see a lot of this in the near future. The city offered incentive to repair and upgrade property. It was grants that I didn't have to pay for. They gave me a $15,000 grant, which covered the cost of most of those repairs. So my gross investment was 20. It turned into $200,000 plus. That doesn't even include the interim income. That value of that real estate, as usual, I regret selling it. The value is probably north of $600,000. Great way to start. small asset, doesn't require a lot of capital, has upside in terms of what you can do for and to the property. So start small. You don't need to talk about buying a giant office building or a regional mall. And we'll go into much greater detail when we focus exclusively on generational wealth. So next week's pop-up webinar, I think we'll spend the vast majority of the time talking about investing in distress and creating that generational wealth. Because again, friends, the opportunity, I haven't seen it this good in the 30 years or since I first started jumping into the business back in the early 90s. The ability to be creative in your investment strategy is going to be significant as well. This notion of a loan to facilitate, where the lender actually gives you a loan that's far better than market, minimize your down payment to get a deal done, is going to be very significant. I look forward to sharing more about that with you when we get there. So let me summarize this real quick. Acceleration of distress transactions. Transactions are off in general in the marketplace about 80% from where they were just over a year ago. The vast majority of future transactions are going to be distressed, meaning that you need to understand the players involved and what motivates them. Loan extensions, foreclosures, restructures, sales, and refinance or rescue capital is going to be a big part of the market going forward. Opportunities to pivot once in a generation. Mortgage pros, learn the business of workouts. If you want to understand that, book a call with me. Brokers, same thing. Yeah, there's my book. There is my contact information, Stephen at Performance Advisory Group. Excuse me, itchy nose. Send me an email. I'll send you a Calendly invite and we'll book a call. So let's talk about questions. So, Roger, in the other section, can you give a few more details? What other section are you referring to? What'd you have in mind there, Roger? The graph of the debt coming due. Okay, got it. It's other property types, if I understand your question correctly. It's other property types. So other here could be mixed use. It could be mobile home parks, could be RV parks. It could be anything other than the categories listed above. Okay. What other questions you have, guys? And by the way, Mika, happy to share with you. Got a lot more I want to share with you. All right, well, let me do this then. Again, here's my contact information. That book right there is free if you go to my website, performanceadvisorygroup.com, or you can go to Amazon, you pay for it there. It's a bestseller. It's a short book, but it gives you a lot of good insight in terms of what you need to know to manage through distressed real estate. Guys, I'm excited about the opportunity. I think it's going to be extraordinary. Our goal is to raise a pool of capital over the course of the next 6 or 12 months of somewhere between 150 and $200 million, and very strategically put that put it in play. By the way, investing in distress doesn't mean you need to do a direct investment. At some point, we'll offer investors the ability to participate with us. You can also invest in publicly traded REITs. They're trading at or close to, some of them are close to all-time lows, but I think there's a lot of downside to those REITs. As an example, one of the larger office REITs came out the other day and said, well, we think that office occupancy is at or close to an all-time low. And my position was great, but what about effective rents? Effective rents will continue to come down. I think I mentioned it earlier. Physical occupancy across the board in the top 10 metros is at 50% of pre-COVID levels. That's a problem. Yeah, Roger, mobile home space, huge, huge opportunity. Although it's one of the favored and coveted asset classes today, there's a lot of mobile home parks, and by the way, multifamily, that have placed debt at the top of the market, meaning in the last 2 years, on an adjustable rate basis. I get those calls almost on a daily basis. And the cost of their capital going up 200-300% has put them in default. And then I would say the cost of mortgage rate caps are up in some cases 1,000%. They don't have the cash flow. Value's down 80%, so they have no equity in the real estate. And this is true for mobile home or multifamily. And so, look, they're in trouble. Thomas, to answer your question about floating rate debt, that's everywhere. When I talk about the wall, the tsunami of maturing debt, guys, that's only a portion of it. That's 1.5 to 2 trillion over the next 2 years. That does not include the groups like Tide Equities that have a huge portfolio, all financed in terms of values at the top of the market. Values are down, and now interest rates are up 200 to 300%. That's going to create huge, huge opportunity. And look, it's multifamily, so that's the favorite asset class, that and industrial. All of this will change. It will change in a very, very real way, which, again, I'm a huge fan of the old saying, buy when there's blood on the streets, even if it's your own. Baron von Rothschild. Einstein said it well, too. He said, in the midst of every great crisis is great opportunity. And that's what I think we're seeing here. Roger, good for you. Let's talk about that at some point. I love, by the way, one of the things I've been searching for the last 20 years is the idea of prefabs on mobile home lots. The prefabs that are coming out today are so superior than what they've been over the last 5 decades that I think that might be a really, really interesting opportunity. So Shiraz, where do we search for or find opportunities? Tune in next week. There's a variety of services out there that will show you, particularly CMBS loans that are at or likely to be in default. And that will give you insight in terms of, you'll get direct contact information for the borrower, location, size of the loan, when it was bought, property type, etc. So there's lots of services out there. I'd be happy to make some recommendations to you. But we'll cover that in much greater detail next week. No, I will tell you, Mika, in Canada, the situation is very similar to here. When I talked earlier about what's going to trigger that next significant downturn in our economy, I mentioned it could be the consumer running out of money. Because again, consumers represent 70% of our gross domestic product here in the US. They're starting to repay student loans in September, and they'll be running out of cash in September. And when that happens, it's going to be a problem. This equity market that is trading at or close to all-time highs will absolutely be affected. I was about to say destroyed, and it could be very well be destroyed. I expect almost across the board, guys, and again, it's just me, that every ounce of gain that we saw as a result of the stimulus in the economy, that 40% across the board, my expectation, we're going to give all that back. And when that happens, that's going to put a lot of downward pressure on our economy. There was so much wealth created through single-family home transactions, and that wealth creation is done. Those transactions are off the table. Roger, send me an email. Reach out next week. Do I think Freddie or Fannie will discount multifamily loans at low rates? Look, I know there's a lot of influence for banks and GSEs, government sponsored entities like Fannie and Freddie and HUD, to offer non-market incentives to borrowers. Do I think they're going to get down to 3.5% fixed? No, because those bonds have to be sold. And unless somebody like the federal government wants to subsidize those bonds should, at 3.5%, those bonds should be trading at close to, depending on the loss per position, they should be anywhere from 4 to 7% or more. So I think the answer is, Cynthia, unfortunately, no. We do work with Freddie and Fannie. Look, over the course of the last few years, I've bought maybe $600 million worth of multifamily. I stopped buying when cap rates started to fall below 6.5%. We bought all on adjustable rate basis because the general trend at the time was downward for interest rates, and we absolutely crushed it. But we said cap rates shouldn't exist at 3% or 4%, because that starts to become synonymous with 10-year treasuries. And there's a lot of risk in multifamily. There's a lot of risk in commercial real estate in general. So look, the answer is 2 years ago was a really bad time to buy. You made the situation even worse if you did it on an adjustable rate basis. For those who fixed their rate at 3%, 3.5% 2 years ago, brilliant. What you have then is one of your greatest assets. It's a liability by definition, that loan, but it's also an asset because you're paying far, far below market for your cost of capital. So in many, many cases, doesn't really matter if you have a fixed rate debt situation and you've got sufficient cash flow, your value is not important, or at least not as important as your cash flow position. So values will come and go. Office is a really great example of this. Office valuations have declined. In some cases, I pointed out earlier, 95%. Office values will come back. It's not if, it's when and to what degree. But the work from home phenomenon is a major problem. Here's my 2 cents on office, by the way. I love it. Historically, it's been sort of the blue chip in the CRE space. Fell out of favor a little bit because of the work from home phenomenon. And we've seen the best and the brightest default. But work from home is largely supported by very, very low unemployment rate. And as that unemployment rate ticks up, employees are no longer going to be able to say, I'm not going to come into the office today. If you want me to do that, I'll quit and go work down the street. Those days are largely over. And plus, work from home phenomenon it's not sustainable. Can you imagine learning your business not being in an environment where you have a mentorship and constant communication and interaction? I think the answer is no. At least for me, I could never have learned my skill set, whether it's management or investment or loan workouts, without being in a participatory environment. So it's going to reverse itself, guys, and it's going to reverse itself, and office will come back. Cynthia, early payments or early payoffs. I'm not sure exactly what you're referring to there. Can you give me some more detail? And Peter Hom, thank you. I appreciate it. Tell your friends, guys. I would love to get the word out there. I would love to see, when we had 40, 50 people here today, I'd love to have 100, 200, 300 people. Not that I really enjoy this, but it's it's a very important part of what's going to happen over the next few years. Learning the core business of distressed commercial real estate will either make or break you. If you do not pivot as a service provider, as an owner investor, or a potential investor, this is going to be a time of a lot of pain. If you do pivot, it's going to be a lot of opportunity for you. It's happened before. I think I mentioned the Barry Sternlichs of the world, the Sam Zells of the world. They crushed it, and they started buying small distressed office assets, small distressed multifamily, and notes as well. John, what do I think of hotel conversions? Conversions to what? Multifamily? Okay, my general thought on multifamily is it's overbuilt. People have been saying, which I think is a great myth, that we don't have enough housing here in the US. The lack of housing is really a function to me of overstimulus of demand. In other words, there was way more demand than there was supply because there was too much capital and the debt was too cheap. I think that's going to reverse. It does reverse in every downturn. We end up with a glut of housing on the market. And the same is true with multifamily. Did you know that this year we have more multifamily coming online than we have had since 1979? Values are coming down. They've come down an average of 18% for multifamily from their peak. Rents are coming down. And now stay with me on this. Rents peaked because individuals were rich because of all that liquidity and M1 that was dumped into the market. Rents are coming down because that household wealth is going down. As that happens, values will continue to fall. And so do I think hotel conversions is a great idea? I don't know. Look, there's always an opportunity. You look at the hotel conversion to multifamily. In some situations, in some markets, you could absolutely crush it. In many situations, you will be crushed. So being able to underwrite it, put the right business plan together, put the right pro forma together, and put the right proposal together for both your existing owner and the lender is going to be everything. Planning out your project is huge. It's going to be the difference between success and failure. Affordable. Look, affordable housing is a huge issue here in the U.S. And with the increase in interest rates that Federal Reserve has forced down our throats in their attempt to push down the very inflation that they caused. And let's be really, really clear about this. The Federal Reserve, through their grossly reckless monetary policy, caused the inflation that we see today. They're managing it, but in managing it, they're hitting our economy over the head with a sledgehammer. Affordable, it's a difficult road to hoe. Today, if you could find the right hotel asset in the right location, I think, yeah, downtown locations might be a really good option. Okay, here's an idea, guys. Came to me last week. How about we buy one of those cruise ships? How about a city or a county or a state buys a cruise ship that's about to be decommissioned and salvaged and park it off the coast of Long Beach or on a dock in Long Beach and use that to house some of the homeless? Use that to clean up the streets. And because that matter of war zones is a huge problem for your economy, particularly in downtown locations. Nobody wants to be in office. Retail's closing left and right. So it's a huge issue. John, affordable housing, maybe it's slightly different than home housing the homeless, but what do you think about that idea, guys? Giant cruise ship, 500 rooms, 1,000 rooms. We take the homeless off the street, put them in a cruise ship, and I guarantee you this, can almost guarantee you with absolute certainty that we'll spend less by buying the cruise ship and housing the homeless in that cruise ship than we would be in our misguided attempts to create other solutions for them. What we're doing to them is just showing them we don't care. I think it's tragic. Dr. Bott, thank you. I appreciate it. Thank you all again for being here. It's been my pleasure. Hopefully each week we bring more knowledge and value to the equation. If you have questions, send me an email, book a time. We'll get together again. Over the course of the next week, we're going to roll out our Invest in Distress or our Code to Generational Wealth program. I expect a lot of you guys are going to want to participate in that. We're going to give you the keys to the kingdom. We're going to show you how to identify, underwrite, capitalize, close, manage, and refinance commercial real estate. It's been done time and time again in single-family homes. That's not a super efficient model. Commercial real estate is far more efficient for so many reasons. So look, guys, again, I hope you enjoyed it. It was my pleasure supporting you here. Oh, Matthew, what do I think CMBS special servicing rate will climb to by the end of the year? I really, it depends on the asset class. It could very well be, try this on for size, that multifamily could be, we'll see the largest gains in terms of delinquencies, quarter over quarter, month over month, and year over year because of all the investment. it was the favorite asset class for the last 2 years, and people jumped in with huge buckets of liquidity, and most of them financed it on an adjustable rate mortgage basis, which is just ludicrous. So special servicing rate, it's going to grow. It's going to grow exponentially over the course of the next 12, 24, 36 months. CMBS traditionally are not super efficient at resolving their debts, far less efficient than a bank, even regional banks. And so, and there's some innate built-in conflicts there, but what I've seen this go around is special services have been far more amenable to things like discounted payoffs and loan modifications and restructures, particularly for those assets that have maturing debt. Looks like that's it, guys. Oh, thoughts on U.S. credit downgrade from AAA to AA? I don't know. It's happened before. I don't know if it was during 2008 or 2000, but it happened before. Not huge ramifications. The bigger issue for me is that the Treasury had to repack their general account. So they have funded and will fund by the end of the year $1.5 trillion. And in selling that much in additional securities, bonds and bills, they are effectively flooding the market. When you flood the market with a security that's a bond-like security, yields will rise. And as those yields rise, it looks a lot more like quantitative tightening. And that increase in interest rates is just going to make everything a little bit worse, guys. Hey, again, thank you. It's been my pleasure. It's been my honor. Come back next week. We'll have more to talk about. We'll be focusing primarily on how to invest in distress and make your generational wealth. Have a great day, guys. Happy Thursday.